This is the Metal Commodities Recycling Report by Benlee and Raleigh Goldsboro Recycling, December 5th, 2016. Last week, commodity prices were mixed while economic reports remained positive. U.S. steel production was about flat as we hear mill order rates are increasing, which goes along with better employment data and increased vehicle production. Oil rose to $51 a barrel as OPEC agreed to cut production for the first time in 8 years. This is a major reversal from 2 years ago when OPEC could not agree on a limit and prices collapsed. The oil rig count rose to 477, up 51% from earlier in the year, yet down 70% from 2 years ago. Increased steel used in these rigs will help support steady to higher steel prices. Iron ore ended up at $79 a metric ton, more than double the price of a year ago. An amazing transformation in just 12 months, which is driving higher steel and scrap prices. Ferrous scrap prices remain steady, but increases of $30 a gross ton and higher have hit in recent days, with some finished goods steel up over $100 a ton in the past 60 days. There remains more upward pressure on scrap. Hot rolled galvanized steel, now up at about $850 a ton, is up $150 a ton in 2 months, an enormous move in a short period. Stainless scrap 304 held steady at 33 cents on no major news or demand changes. Copper fell 5 cents to $2.62, holding much of the recent increases, while transaction prices continue to lag due to limited increase in demand. Prices are up 5 cents just this morning, mostly on news about yesterday's resignation of Italy's prime minister and strong China growth numbers just this morning. The 5-year copper chart shows prices at about 15-month highs, and copper inventories continue to fall, helping support the higher prices we're seeing in the market. Aluminum fell 2 cents to 78 cents, yet up about 18% for the year on continued slow increased consumption. Aluminum inventories have stabilized at about 8-year lows, supporting higher prices, which could lead to increased production, bringing stable prices in the months to come. U.S. vehicle sales fell to about an annualized rate of 17.8 million units in November, yet are still near last year's record. Again, this is U.S. vehicle sales, not production. Sales include imports from China, Germany, Korea, Mexico, and Canada. This chart shows production for Canada, Mexico, and the U.S., and it tells a more interesting story as relates to jobs on our continent. It shows that we are at record levels of vehicle production. Mexico is the big winner going forward. Mexico made about 3.5 million units year to date, and they're scheduled to build 5 million in 2020. The unemployment rate that most mention is called U3, the gray line, which fell to 4.6% in November, the lowest since 2007. The orange line is the U5 that adds workers that are not looking for jobs but want a job to the U3. That is down as well, but it's about 6%. Now add part-time workers that want full-time jobs, the U6. That is 9.3%, which is down from 17% at the height of the recession. Like many things, the unemployment rate is complicated. Related is the labor force participation rate, which is the number of employed and unemployed looking for a job as a percentage of the population aged 16 years and over. Less than 63% of the workforce is participating, a huge growth opportunity. GDP, gross domestic product, the best measure of the economy, grew at 3.2% for the 3 months ending in September, up from 1.4% in the previous 3 months. The increase was led by increased consumer spending and exports. 3.2% is the highest growth rate in 2 years, a great overall economic performance. With that, we hope all have a safe and profitable week.